Hey there traders, I'm Lance Beggs from YourTradingCoach.com. Welcome back to our series on price bar reversals. In this video we're going to look at the bullish rejection pattern. Okay, this one is going to be so easy, assuming that you've already been through the last video when we discussed the bearish rejection pattern. Let's begin with the definition of the pattern. The bullish rejection pattern is a bullish reversal pattern. Pretty simple, hey? It consists of only one price bar, as displayed in the example on the video here. The open and close must occur in the upper third of the price bar range, so provided the open and close are anywhere within this green area here, it meets the definition. Let's look at some examples. This is a valid bullish rejection pattern. The price opened here at the tab on the left, which was within the upper third, and closed here a fraction higher at the tab on the right, also in the upper third. Same here, a valid pattern. Even though the close in this case is below the open, it's still in the upper third, so therefore a valid bullish rejection pattern. And same here, where both the open and close are at the same level. Looking now at an invalid bullish rejection pattern, we have price in this case opening in the upper third, but closing the price bar down in the center third, therefore not a valid bullish rejection pattern, which requires both the open and the close in the upper third. Anyway, I think you get the idea. As long as the open and close are both in the upper third of the price range, it's a valid bullish rejection price bar. But this doesn't mean you should automatically enter long whenever you see one of these price bars. You need to consider the context of where the pattern's displaying within the price action. In other words, the setup. Now for starters, the pattern, or the bullish rejection pattern, must occur within a downtrend, so price trending downwards towards the pattern. Let's demonstrate what I mean by that. We have two options here, either price trending down with lower highs and lower lows to the bullish rejection pattern, or equally valid is the downtrend occurring within the context of a longer term uptrend. So in this example we have price trending upwards here with higher highs and higher lows, and the bullish rejection pattern occurring at this point here at the end of a counter trend retracement. The point is that the bears have been in control, driving prices lower down towards the pattern. And for an even higher probability setup, you would ideally have price falling into an area of support marked by the yellow bar here, with the bullish rejection pattern rejecting prices at that support area. Confirmation of the pattern and the trigger for entry comes through price trading above the high of the pattern at this point here. Of course, that can be varied once again depending on your personal preference. If you're willing to seek less confirmation, you might be willing to enter immediately after creation of the price bar. Or if you prefer further confirmation, you might be looking for a close above the high of the bullish rejection price bar. Once again, whatever works for you is fine by me. Let's look at the psychology or sentiment of the pattern now and see who's in control, the bulls or the bears, to try to understand why this pattern works the way it does. The bears are clearly in control, leading down to the pattern here. Supply is greater than demand, driving prices lower. The bears' dominance is initially unthreatened by this price bar as price opens here and continues to be driven down to the low point here. At this stage, the price bar has the closing tab down here at the lows and is looking incredibly bearish. However, this is the point where balance between supply and demand has now shifted the other way. At this point, supply has now been overcome by demand, and the increase in buying pushes price back up to close at this point here in the upper third. The previous dominance of the bears is looking threatened. As price then trades above the high here, we get confirmation that lower prices have been rejected and that we're now potentially commencing a bullish move, hence the name bullish rejection pattern. The up move at this point is propelled through a further increase in buy orders from those entering long on the breakout and also from the shorts exiting after having tightened their stop to just above the high of the pattern at this point here. A final point on the sentiment of the bullish rejection pattern. Obviously, the higher the close, the more bullish the pattern. In both examples here, the bulls were able to push price to close in the upper third. However, in the first example here, they were also able to push price up to close above its opening price, obviously displaying greater bullish strength than in the second pattern, where they could not close above the open. So let's check out some examples. Here we are on the Euro US dollar 1 minute chart for those of you who like a bit of fast price action. We had price holding for a while up here at support at the 1.3 level. 1.30000. Price broke below that level and came on down to the next expected support level at the 1.2950 level, marked by the red here. We can see evidence here of demand overcoming supply at that support level through the creation of the bullish rejection pattern in this price bar. Price trading above the high of that bar at this point here offered the opportunity to enter long. Of course, being an astute trader, you would have been targeting the previous support, now turned resistance, back up at the 1.30 level for an excellent 30 pip profit potential. A bullish rejection pattern at an area of support. Love it. And this second example is a great one to highlight a very important point which hasn't really been mentioned so far. So I hope you persisted with the video to this point, otherwise you're going to miss this, and I'm basically just talking to myself. Anyway, you'll see here that price has been falling here on the Euro US dollar daily chart, down to the low point here, identified by a bullish rejection pattern. Price opening and closing in the upper third, and then price trading above the high of that pattern. So price trading above the high here to confirm the pattern. Notice though that the price does not rally, but rather enters a rather choppy, sideways, crappy trading range. This highlights an important point. As with candlestick reversal patterns, the price bar reversal patterns have been poorly named. There is no guarantee of a reversal. All the pattern is indicating is a short-term change in sentiment. We take this to mean an increased probability of a trend change. However, the reality is that it might also enter a period of sideways movement, as in the example here, or the pattern may even fail and continue lower. Trading is all about probabilities. We identify setups where we believe the odds are in our favour and take the trades and then manage them, but we always have a stop loss to protect us from those times where we just got it wrong. Okay, so coming up in the next video, we're going to look at the open close reversal, and then we'll follow that up with a few other price reversal patterns: the closing price reversal, the hook reversal, the key reversal, the island reversal, and the pivot point reversal. I look forward to speaking with you again soon. I'm Lance Beggs from www.yourtradingcoach.com, wishing you, as always, many profitable bullish rejection patterns.